Well, folks, it's the rare buy one, get two free here today. First video up here is one I've been wanting to react to for several days now. Yes, Fundstrat's Mark Newton. Oh, you know who friend that is, Mr. Tom Lee, our favorite bull, okay? He says buy weakness on the S&P 500. I want to hear what he has to say here and react to that one. Then we're going to react to this video that came out 2 hours ago. The equity market is not worried enough about savings going dry, says SoFi's Liz Young. So we'll react to that, give my opinion on that video. And then this one from 6 hours ago, you know who I am. I run to the cheaper stocks as a Jim over here, okay? So we'll hear what he has to say about running to cheaper stocks, and I'll give my opinion. And let me say this, okay? I've been wanting to record outside, but dang, it's been cold, and it's cold again today. You know, February in Vegas, you know, one day it's like 60s, it's super nice, and next day it's like down the 20s. My agaves are dying in the backyard here, man. Like, weather in Vegas is crazy. You might not think it's that volatile, but believe me, it's all over the place. So I appreciate everybody joining me as always. Thanks for being subscribed. 23,500 or 23,600 subscribers now at this point in the channel. I mean, just amazing. So I appreciate every single person. And the only other thing that's might be going up faster than this channel is the Patreon, which thank you everybody that supports the channel on Patreon. It's like $2.50 a week to be part of that, and you get to see the buys and sells in my Patreon portfolio every single week. So yeah, if you're looking to join us in there, that will be pinned comment. Thank you everybody that supports in Patreon, and glad you guys are enjoying that in there. We got one of the fastest growing Patreons in the world right now, one of the fastest. It's insane. So appreciate everybody. We're on the road to 1,000 patrons in there. Let's get into this.
That stocks are going higher. Today doesn't upset that at all?
Well, Scott, we were down right near 4,100, if not below, and we managed to recover the entire early sell-off. So, you know, I know a lot of investors had expected some type of a St. Valentine's Day massacre. If anything, this was a nice
I apologize, folks. This was 2 days ago. I think I said 3 days ago. This was on Valentine's Day.
High for the bulls on Valentine's Day. We recouped all of the early losses. So, you know, it all has to do with three things, in my view, right? Seasonality. February, particularly in pre-election years, is far more positive than it is in regular years. We're up almost an average of 1% on average versus being negative. So we're in the most bullish quarter of any of the 16 quarters of the 4-year cycle. Sentiment, even though it has gradually started to get more bullish, still very, very pessimistic overall. We have 65% of investors that think that this is a bear.
No, this is crazy because this was a point I brought out months ago. Do you guys remember when I was bringing out this point about, and I was basically showing you, and what I was showing you was I was showing you basically the 6 months and the 12 months after midterm elections. And the market is almost always up 6 months and 12 months after. And most of the time it's substantial. And I was showing that to you guys several months ago, and so it's interesting to see that exact thing playing out. Midterms got over, right? And next thing you know, market's off to the races in performing almost identical to how you see it almost every single time. Crazy.
Market rally that we actually could go down and test the lows. You know, and the third is safe haven underperformance, and I think that's also interesting. The three S's. We're seeing defensives, utilities, and REITs all sell off sharply. That's not something that typically happens ahead of a big pullback. So the reasons for why the market should go down technically are just not there. Interest rates, of course, have backed up a little bit. That is something to watch. I see rates actually reversing and pulling back into the month of March, if not April, lower. And given the correlation, that should be bullish for equities.
I know, but it's like, you know, rates going up is not and oh, by the way, and rates are going up. It's like, how high are rates going to move? How quickly might they get there? And can stocks withstand that?
Stocks have withstood that. If anything, stocks have been far more resilient given the treasury market sell-off that we've seen in the last 2 weeks. I think rates have been up the last 6 out of 8 days. Stocks have barely budged. I mean, we're largely unchanged in the short run. So in the back half of February, you know, to the bear's credit, you do tend to see a little bit more evidence of consolidation and possible weakness. But I think that's going to prove minor. I don't expect the S&P to get down under 3,900, even on weakness. I'd be a buyer, and I fully expect that we're going to push back up above 4,250 into March. So, you know, momentum is there. Breadth
above 4,250 into March. Interesting.
Technology has clearly come back. Look at semiconductor strength. It's simply formidable. It is an amazing sector right now, and all cylinders. Everybody's negative, thinking, well, why is the market going up when earnings are going down? Well, that's exactly the reason you want to see when everybody is saying the same thing. then it's right to expect this rally can continue for maybe reasons that investors don't understand.
You've taken a look at one stock.
No different than, and that's a great point he brings up, right? And many times in the market, you see the market going down, and people are like, why is the market going down? Earnings look great right now. The economy looks good, and you see the market moving down and down and down, and people don't understand it at the time, right? It's hard to fathom. It's like, this doesn't make any sense. This is just a buying opportunity, right? And then all of a sudden things deteriorate more and more and more, and it's like, oh no, now it makes sense. And then you see the market bouncing back several months in a row, and it's like, how is it doing that? Earnings aren't strong right now. The economy doesn't look strong. This doesn't look strong. And you see the market just rallying, and you're like, this doesn't make sense. But you know what happens? Do you know what happens almost every single time? 6 months down the road, 9 months down the road, sometimes even 3 months down the road, earnings start picking up from companies. And next thing you know, the biggest companies in the world are reporting their earnings are getting better. Their margins are getting better. Their revenue growth is getting better. Their outlooks start turning rosier. And all of a sudden everybody says, oh, that's why the market was going up. You don't realize it at the time, but the market's always looking forward 6 months, 9 months into the future, okay? And so that's why I keep talking about the heaviest weighting in the market is S&P 500 and NASDAQ 100 stocks is the top 10 to 15 stocks, right? And what I see coming for those stocks is most of those companies are going to actually see their earnings improve as the year goes along. Improve, as in go up. And most folks in the market are not anticipating any major substantial change. And I think for some of those companies, you're going to see some quarters where their earnings are going up 15, 20, 25% year over year. It's substantial numbers. And the market, in terms of the thinking of the market, a lot of people aren't anticipating that. But in terms of how the market's reacting, it's basically it's telling you a story that's likely where we're going. Time has to play out here, but don't be surprised if in a few quarters from now you start to see all these big techs and a lot of these companies reporting very strong earnings per growth and much more certainty about their business models. Just don't be surprised.
Particular that you like, I'm assuming from a technical standpoint, it's Monster Bev. Is that right?
Yeah, that is part of my upticks list, Scott.
Hey, one of my old stocks from back in the day, Monster Beverage, man. What a beautiful stock. Boy, did that stock treat me good. I took way too many profits way too soon on Monster back in the day. This is back when it was actually called Henson's Natural Beverage, but interesting. What does he have to say about Monster?
List that I run for Fundstrat and FSI, and so that's been in the list for the last few months. One of my favorite staples. I don't love the staple sector, but this is certainly an outperformer and recently has broken out to new all-time highs after a couple months of consolidation. So I love this name technically, yes.
But you don't want, to your point about you don't love the staples, you want to move further away from the 2022 playbook and embrace what's working now?
100%. I still want to be in energy, one of my favorite sectors. I think crude has bottomed. I think natural gas is bottoming today and could actually bounce. Energy is a sector investors want to be long from February, at least through the spring. That's a seasonally bullish time, and I think crude oil has bottomed as well. Healthcare should be on the comeback. So I think that's an area investors want to take a close look at, specifically biotechnology. Technology, to its credit, has come back very sharply in recent months. That's also good. And industrials, those are my 4 top outperformers for the year. So yes, avoid the staples, avoid utilities. You have to be far more selective in what you buy there. I'm very much risk on for the months to come.
Yeah, so crude oil, by the way, I got to tell you something that's just insane that I just saw. Just absolutely insane that I'm like, wow, he just talked about that. So crude oil, by the way, real quick here, I called it back in the summertime when I said, watch out, crude oil is likely going to head down from here, right? And sure enough, it went down substantially from like 120 to in the 70s, right? But his confidence about crude staying down, I wouldn't get so confident about that. I wouldn't be surprised if crude goes back to 90, maybe even $100 a summer at some point in time, okay? 120 plus, I don't know about that story, but don't be surprised if crude bounces back. Usually crude always bounces back in the spring as you push into summer, excitement around travel, right? Could be excitement about the economy, maybe getting healthier as the year ticks along. So I don't think it's out of the realm of possibility at all to imagine crude goes back to $90 to $100 this summer. I just don't. I think people were way too bullish on crude back in the summertime when I was telling everybody, you're all crazy, okay? And everybody in the world, everybody that go on CNBC, Wall Street, everybody was talking about crude. It's going to go up more. And I was like, no, it's not. And sure enough, it went down, right? And now I feel like people are too bearish on crude. And don't be surprised if that baby bounces back in the spring and summer. Now, next thing I want to talk about here is something absolutely insane. Because this gentleman basically just said that Monster Beverage is now a staple stock, right? And that's just crazy to me, because back when I was investing in that company, it was a growth company. And so it's amazing to see, you almost like date yourself in this market, right? To see a company like that I was investing in back in the day, and it was a growth company, to now be considered like a consumer staple. It shows you how time ticks along, man. Absolutely amazing. But Monster's a great company, by the way. They got a very good product. Let's just call it that. People like to buy it over and over and over again. Next video up here from 2 hours ago, Liz Young, the equity market is not worried enough about savings going dry. Okay.
With me at Post 9, this speaks to, welcome back, it speaks to the don't fight the Fed versus don't fight the tape. Mester's out today saying, yeah, I would have done 50. Bullard, who's not a voter, but still says, 50 may be needed. Yeah. What do you make of all this now?
Well, what's funny is that if you rewind about a month ago, the market was behind the Fed. The market was saying we're only going to get up to, 5, and then we cut a couple times before the end of the year, and the Fed continued to say, no, we're getting above 5, we're going to hold it there. And now here we are. The market finally agrees. So it's almost as if the bond market, the futures have agreed with the Fed. They listen. The equity market, in my opinion, is still not quite listening. And
so
a lot of
that
that
is in denial. The equity market's in denial.
No, I don't think the equity market's in denial. I think the equity market is listening to the data about the consumer that's concurrent, right? Mm-hmm. That there's retail spending that bounced back, that consumer confidence bounced back, and that services PMI bounced back out of contraction. There are things to be happy about. The labor market is still tight, right? But what I think the equity market is not pricing in at this point, or is not worried enough about, is that the consumer spending at some point, savings run dry. And wage growth is falling. It can't support that level of spending going forward.
Well, did you see the New York Fed number today about debt, right? Debt's piling up, credit card usage is piling up, delinquencies are increasing. Is that worrisome to you?
Absolutely.
That's like a signal that, okay, this can only last for so long.
Of course.
This consumer strength.
Yeah, and I question some of the narrative around we've got all this pent-up savings. Everybody's sort of sitting on these stockpiles of cash. Well, the savings rate fell below 3%. We're at lows in the savings rate. If all the spending is happening on credit cards in a time when credit card rates are higher than they've been in decades, that's a problem. And at some point, people will run out of money. They're not worried about running out of it yet because they all still have jobs. Mm-hmm. And it's easy to find a new job, and wage growth is hot. But the PPI numbers today, too, did not give me a lot of confidence that inflation is going to continue to come down at the same clip that it has been coming down. I think that's another thing that the equity market is hanging its hat on, saying that, look, it's going well. It's going to continue going well until we get to target, and then we all sort of live happily ever after. And I just don't think it's quite that easy.
All right.
Okay, so first off, she brings up some good points, but there's something so key she's missing here, okay? She's talking about consumer savings and those sorts of things, but what she's missing is we've had 2 straight months where consumer savings has increased. We're still at very low levels, but the bottom line is we could have troughed when it comes to consumer savings. We don't know for sure, right? But the trend has switched now, and the trend is going back in the right way in terms of consumer savings. So, the consumer got obviously wrecked by inflation last year. It took everybody by complete surprise, right? And no one was really expecting that, including people at the Fed. I mean, from the highest levels of Wall Street, the Fed, most educated economic folks, no one expected inflation to go as crazy as it did, right? And so consumers got completely taken off sides, and it depleted a lot of savings, right? But we have seen 2 straight months where savings has gone up. So I don't want to say for sure we've troughed, but it's definitely showing a troughing type signal, okay? In terms of debt, reaching a new all-time high or something like that, you should see that every year, okay? As assets increase every year, usually, right, in a perfect world, you should usually almost always see debt increase, okay? So they make a big deal about that, but it's like that chart should get bigger as the economy grows over time. Credit card, it'd be beautiful if no one had credit card debt, no one had mortgage debt and auto loan debt and all that stuff, right? That'd be cool, but that's very unrealistic. As the economy grows over time, assets should grow over time. Liabilities should also grow over time, okay? But as long as assets are outstripping the liabilities by a little bit over time, it makes a massive, epic difference over time, okay? And so I just think that's important. Everybody makes a big deal. Like every year, you should see more debt than the previous year. Like that's natural, okay? So anyways, and especially in an environment where consumer got completely taken off sides. So, you got to look at these things both ways, in my opinion.
I just want to let everybody know, I told you at the top that there are a lot of earnings coming out. It's Applied Materials, which, by the way, is out. We're going through it. Our reporter's going to come on in a moment. We're going to see exactly what the stock is moving. We got Dash coming out, DraftKings as well, and we're keeping an eye on those balls, too. So we're not going to miss any of that.
I haven't got to see AMAT yet, but I believe DraftKings and DoorDash were both up big. If from what I saw, previously, I've been a little busy prepping videos and doing videos, but from what I saw, that was kind of what happened there.
Give you everything that you need to know there. Yesterday, Victoria Green was on the program, said this is the start of a new bull market. And you have been very, open and honest about...
That's such an AMAT move, 2% after hours. Such an AMAT move. Oh, gosh. Bull market. What is he saying here? Is somebody saying about a bull market?
A new bull market. And you have been very, open and honest about feeling run over by this market to start the year, right?
Yeah.
Position sort of thinking differently of how it was going to go. So given what she said about this new bull market where you've been, how does it all play out here then?
So I think the fight the Fed versus fight the tape is also fundamentals versus technicals. There are a lot of technicals that would signal to people that maybe they look similar to they have in the past during a new bull market. I'm still not in that camp. I think that we're probably supported in this range between 4,000 and 4,300 on the S&P until and unless something bad happens, or until and unless the Fed says, you know what, it's not going the way that we thought. I don't think that a bull market starts at this point.
She totally missed it, man. She just totally missed it. She didn't even say and bring out the point of earnings going stronger. Let me ask you this, okay? You want to know what really runs the stock market over time? Do you want to know why the stock market over time goes up or down? The biggest reason is earnings. Look at S&P 500 earnings over the last 15 years. Look at S&P 500 earnings over the last 10 years. And they will tell you the story on why the stock market's gone where it's gone over time. If S&P 500 earnings go down a bunch over the next 10 years, it will be a bad 10 years for the stock market. And it's pretty much as simple as that, okay? All these other things are factors to play. But the biggest factor at the end of the day for the markets over a 5 or 10 year span is earnings increasing or decreasing, okay? And she just totally missed the possibility that earnings strengthen as 2023 goes along. And you can't miss that point, man. But unfortunately, none of these Wall Streeters are really talking about that enough. If they ever do bring up earnings, it's that, earnings are going to go down in 2023. And it's like, dude, you're not even like looking at this other possibility here. You've got to be balanced in the market. You've got to look at the bads, you got to look at the goods, and you got to weigh all these things out. But the fact is, a lot of these bearish folks aren't even considering earnings increasing, margins increasing for the biggest companies in the world as 23 goes along. And I just think that's why so many of them are offside and so many of these money managers are way offside. At the end of the day, these money managers have screwed up bad, okay? They went into this year not nearly enough invested. On a year where you came off of a year when the NASDAQ went down 30+%. You're going to go into the next year not heavily invested when after midterms, like usually the market does great that next 6 to 12 months, almost always historically. And you're coming off of a rare instance when the NASDAQ's down 30+% and the SP 500 goes down 20+%. Like, how are you going to go into that year off sides like that? You can always hedge on the other side, right? I'm hedged on the other side. If the market tanks, I make a bunch of money on different put options I have, right? You can hedge, that's fine, but you can't go into a year like this off sides. And these folks did. They went in not nearly heavy enough invested, and now a lot of them are like looking around, and now they're hoping and praying that the market goes down. That's what they're hoping and praying this market goes down because they're so far off sides in this game. And it's like, dude, that's not a comfortable place to be in this market.
In the cycle, I still think that you have to get to the point where the Fed at least pauses. You have to get to the point where at least some of the demand bakes into the data in the economy. And I think the valuations at this level, you don't see a new bull market starting 17, 18 times forward earnings. I mean, then it's like, where are we headed to?
So when
25?
people say, well, what if this time is different? And you just don't.
She missed it again. Have you even taken into account that earnings are going to be far stronger than folks on Wall Street expect? As in, they were far worse last year than everybody expected. She's just missing it over and over and over. But her stance is like a lot of these Wall Streeters, they aren't even considering this other possibility.
I think it is.
I think that the rally that we've seen so far this year has been very rate driven. I'm not saying it wasn't true, but I think it was very rate driven. We saw rates come down quite a bit. We saw growth rally. If you look at the sector makeup of that rally, it is all that rate sensitive stuff. And then even just the sell off today, almost perfectly patterned in the opposite direction, right? And the sell-off today, I think, was the Fed comments. It was also PPI. So that's rate driven in the other direction. If it's rate dependent and we're headed higher in rates, then what we've seen, this rally is not necessarily a new bull market that's taking shape.
So I like a lot of the points Liz Young brings up there in regards to some of her, bearish points. But like I said, she's just not even considering. She's not even considering the possibility that earnings increase quite a bit and margins increase quite a bit for the strongest companies out there, the heaviest weights in the market. And those are things you just have to consider, man. You have to consider those. And just they aren't considering it, man. And we'll see in a few quarters how these companies' earnings are looking for the big dogs. Don't be surprised if you see margins increase, profitability increase, and cash flows increase for most of them. Okay. Next one up here. You know who I am. I run to the cheaper stocks.
But we're still down across the board. Rates, though, today are not lower. 383 is where the 10-year note yield currently sits. So we're going to watch that. We're going to get into all of the market stuff, PPI and everything else, but we do have new moves from the committee today that I want to tell you about first. Josh Brown, who's been active lately, pretty active. You bought DocuSign. I want you to tell our viewers why you bought DocuSign.
Good question. No, look, this is
Oh gosh, he's like, hell, I don't know, man. What do they even do? What do they even do, man?
This is for me a situation where I've never owned the stock. I watched it run to 300, and then I watched it fall to 40 something. Now it's back in the 60s. They don't report until March, I think 13th or 15th. So,
do you guys remember, for people that have been in the market a while, if you're newer to the market, you might never have seen this before, but I think actually most of the people that watch this channel are been in the market for quite a while. Do you remember, this is like kind of the peak of the market, like late 2020, early 2021, some guy went on CNBC and I think it was Upstart stock. And he's talking about they're buying Upstart stock, and the guy for CNBC asked him, well, what do they do? And he's like, what's that? My mic breaking up. I can't hear you. And he's like, what do they do? And it's like, I'm sorry, I can't hear you. It's so ridiculous. If you've been in the market a while, you probably saw that whole situation. It was hilarious at that time.
This is the kind of thing that I normally do. I buy a very small amount, wait for the big bad news. If it's an overreaction to the downside, I add to it. And if it's not, and the stock continues to break out, at least I've got some position on. It's the way I've always bought very volatile stocks. And that's what this is. But I think what's important here is the company this morning put out news that they are further reducing headcount. They know what the playbook is. They've watched all the other technology companies do it. DocuSign is a verb and a noun in modern society. Even though there are competing services, we refer to those as DocuSign. I think they have an enormous business, a sustainable business. There is some question about whether or not they have an enduring competitive edge, and that's why the stock has come down as much as it has. But they are still growing in the mid to high teens, double-digit growth. And I think this is a stock that, this is a consistent theme for me right now. It got thrown out with the bathwater. People were calling it a stay-at-home stock. It's very stupid. I have 20 people in my office right now. We're still using DocuSign. It's not a stay-at-home stock. I think it's a great business, and when they get to profitability, which is coming sooner rather than later, I think they'll have a newfound level of respect. So it's the start.
Do I view DocuSign as a buy or a sell? My opinion on this is, I actually think it's kind of a no touch. I actually think this is I think it's an acquisition candidate. And, I wouldn't be surprised if Microsoft tries to make a move on them over time. I think that would be a great kind of piece to them. I wouldn't be surprised if somebody like a Google tries to make a move here, maybe a Salesforce. But I really feel like DocuSign is I think it's an acquisition target. I don't really think they should be a standalone company. I think I kind of view them almost as like Snapchat, right? Where Snapchat could be a standalone company, but should really like be owned by somebody like a bigger parent company. And that's the way I feel about DocuSign. I just feel like it's kind of out there. It's like, it might do okay over time, but not super attractive asset. I just think there's much more attractive opportunities in this market. And I honestly feel like there's an acquisition possibility out there.
An investment. I'm not calling the bottom for the stock. It may go lower. I'll add to it if I get an opportunity.
I mean, you can't call the bottom. It's already 70% off of its low, right? Now, I want to ask you.
I mean, it's had a nice.
Buying it here, buying it
move.
now.
That's right.
Can they get rid of the notary?
But I mean, what I'm saying is, yes, it's already had this great move, and you're undeterred by the fact that it's already come 70% off of its low, Josh.
Well, whatever has happened in the past doesn't really make me any money, in the future. So, of course, in a perfect world, you're sitting there trying to buy the absolute bottom in stocks and sell the absolute top, but that's not really what I'm attempting to do. I want to be an investor here. I want to give myself the opportunity to buy more if the stock price goes lower, and I want to follow along the company's progress as it gets to what I think will be positive free cash flow, positive earnings, and it will no longer be considered one of these high growth, no earnings stories. I don't think you can wait for that. As we've seen with several other companies in this group, I think you have to say to yourself, which of these companies has a business that I would want to be invested in 2 years from now, 4 years from now. It's not a trade, for me at least. I know there are people that are trading it.
I got you. The other piece of business I want to get to before we get into a broader conversation is Jim.
I'm glad he clarified that, by the way, because so many of these folks will go on Wall Street and they'll talk about buying a stock or whatever, and it's like, you're buying it for tomorrow, for the next week, for the next month, for the next year, for the next 10 years, and many times you never really know. So I do appreciate him bringing out that there.
You're going to buy Oracle today, which Josh, I'm sure, is happy.
By the way, in my opinion, a stock that I like a lot more than DocuSign, if you want to kind of play in that space, that stock, in my opinion, is DBX, Dropbox. I actually like Dropbox better than DocuSign. If you're talking about the next 3-5 years, in the next 3-5 weeks, who knows? Okay, maybe DocuSign does better because they had the recent layoffs. But, I definitely think Dropbox is just a better play. They're a lot further along in their business. They have a great balance sheet at that company, impressive income statement, and you get diversified. You obviously have the cloud product. You have a competing product to DocuSign and HelloSign and a few other businesses that Dropbox has. So, in my personal opinion, I actually like the risk reward in Dropbox better than DocuSign over this next, let's call it 3 to 5 years.
Maybe you got the idea in part from him buying it the other day. Why Oracle?
I'm going to tell you this.
Actually, now I'm going to sell it.
Why Oracle?
Seriously. I didn't mind the endorsement. I mean, it wasn't Josh. My team's been looking at this for quite some time. But here's the answer to your question. Here's the narrative. You remember on Tuesday, I told you I sold Salesforce. I was underweight tech going into that. Now I'm really, really underweight tech. And I don't want to be that underweight tech. I don't want to be one half the market weight, when tech is like 24%. So where am I going to buy it? Listen, I hope, Josh, you make a lot of money in DocuSign. It's not my cup of tea. You know where I run. I run to the cheaper stocks. For better or worse, I am who I am. I was uncomfortable with Salesforce for that reason, and I'm happy being in Oracle. This is a stock, by the way, that for many, many years, like most of the last decade, nobody gave a hoot about it. It was totally unloved. Last couple of years, sentiment has started to pick up. It's attractively priced, roughly 16 times next year's earnings, PEG ratio of 1.3, 1.4% dividend yield. This is my kind of stock. So when I look at where do I want to be in tech, I want to be in value tech. I hope everybody makes money. I'm not taking shots at anyone. Value tech is where I want to be. You see it working with Cisco today. You see it working with some other stocks like that. I know Steph was on that day, Scott. We talked with her a little bit about IBM. I've been burned too many times in IBM. I'm not going to do that. I need a fresh start. Oracle is there.
Okay.
Yeah, Oracle, a good company, good stock. I just don't understand why you'd sell Salesforce. I don't personally own Salesforce stock, but I'm like, why you need to cash out of that one? You know what I mean? Like just let that baby run. Like Salesforce is one of those companies, if you're going to add a good sized position, continue to build it out over time and just let that baby run. Like it just, there's a lot of stocks in the market. And if you want to trade them, be in, out, do whatever you want to do, right? Not my game, but if you want to do that, I just look at Salesforce as kind of one of those stocks you don't really do that with. You got to build a good sized position there. You continue to add it over time. You throw it in the filing cabinet. So, but anyways, other people run their own money how they want to run their money. I run my money how I want to run my money. If you want to see how I run my money each and every week, including the stocks I buy and sell, check out the pinned comment down there. That'll be joining us in the Patreon and see the Patreon portfolio every single week and the stocks I'm buying and selling. It's a no-brainer to be in there. You have to join us, and it's less than 24 hours between now and me making my next moves in there. That will be pinned comment. Appreciate y'all, and have a great day.